Here is an example of keeping a perpetual inventory record using the FIFO method. For this example, we're going to use the same Kylo Fashions transactions that we had before. Again, they're going to start with 2 navy blue pullover fleeces in inventory with a cost of $35 a piece. They're going to make a purchase on August 5th of 4 units at $36 a piece. They're going to sell 4 fleeces on August 15th at a sales price of $70 per unit. They are going to purchase 12 additional fleece pullovers at $38 a unit on August 26th. And lastly, on August 31st, they're going to sell 10 more navy blue pullover fleeces at $70 per unit sales price. So let's use our perpetual inventory record to keep track of the purchase cost, cost of goods sold, inventory on hand for this item 153, using this time the FIFO or first in, first out method. So for item 153, our navy blue fleece pullovers, we're going to begin with 2 units in inventory at a unit cost of $35 a piece, which means the total value of unit 153 in our inventory is going to be $70 when the month of August begins. The first transaction that we have related to this particular piece of inventory occurred on August 5th when we purchased 4 units at $36 a piece for a total purchase cost of $144. Just like with the LIFO method, we're going to have to layer our inventory. So let's start by bringing down what we had. We had 2 $35 units for a total cost of $70. And then we're going to add the units that we just purchased into our second layer. And in layer 2, we're going to have the 4 $36 units at a total cost of $144. Next, on August 15th, we're going to sell 4 of these fleeces. The sales price is $70, but we're not recording our sales revenue in the center section. We're recording our cost of goods sold, which means we need to take them off the books at their historical cost. Well, now we're using the FIFO method, which means we assume that every time we sell a unit of inventory, it is the oldest piece of inventory of that type that we have in our wares. First in is the first unit that we purchased. Well, what's the oldest units that we have? It's those 2 $35 units with a cost of $70. But we just didn't sell 2 navy blue fleece pullovers on August 15th. We sold 4, which means we have to take 2 more of those $36 units out of our inventory. And now we've accounted for 4 units being sold. We have a cost of goods sold, if you total that up, of $142 for this transaction. What do we have left? We had 2 $35 units, but we sold both of them. We had 4 $36 units. We sold 2 of those 4, which means we have 2 left. Unit cost of $36 for a total cost of $72. Our next transaction occurs on August 26th when we purchase 12 units, and we purchase it at $38 a piece. Total cost of this purchase would be $456. For our inventory on hand, again in our first layer, let's bring down what we had. We had, before this purchase, 2 $36 pullovers for a total cost of $72. And let's make a new layer for what we just purchased, which was the 12 $38 units for a total cost of $456. On August 31st, we're going to sell 10 of these units. Again, it's FIFO, so we assume that we're selling our oldest units first. Well, what's the oldest units we have right now? Those 2 $36 units with a total cost of $72. We're selling 10 pullovers in total. We accounted for 2 of them already as the $36, or took 2 of those units out of layer 1, if you will. We need to get to 10, which means we need to sell 8 of those $38 units, and 8 times 38 means that would have a total cost of $304. And if we add that together, our cost of goods sold on this transaction would be $376. 72 plus 304. What's left? Well, we had 2 $36 units. We sold both of them. We had 12 $38 units in our inventory on hand, but we just sold 8 of those, which means we have 4 $38 units left with a total cost of $152. That would be the value of item 153 that we're reporting on our financial statements at the end of the period. So in total, we purchased 16 pullovers. The total cost of that purchase was $600. What was our cost of goods sold? Well, add up your quantity column in the cost of goods sold section. 2 plus 2 plus 2 plus 8 is a total of 14 units being sold. The total cost of all of those units, again, add up the total cost column in your cost of goods sold section, and you come up with 518. Inventory on hand, just bring down what you had after your last transaction. After we made that sale on August 31st, what did Kylo Fashions have left? They had just the 4 units in inventory with a total cost of 152. To record the journal entries, we'll take our perpetual inventory record using the FIFO method, and keep in mind that our sales price is $70 per pullover. First transaction we had was on August 5th when we purchased 4 $36 units. We did so on account, so the journal entry would be a debit to merchandise inventory for $144 and a credit to accounts payable for that same $144. On August 15th, we're going to make a sale, and the first entry is going to record the sale. We sold 4 units. Our sales price is $70 per unit, which means we're going to record $280 in sales revenue. So we debit accounts receivable for $280, we credit sales revenue for $280. On August 15th, when we record the expense, we're going to have to go and figure out what was the amount of cost of goods sold we recorded on this particular transaction. As we can see from our perpetual inventory record, we sold on August 15th 2 $35 units and 2 $36 units. Well, if you add all that up, 70 plus 72, we record a cost of goods sold of 142. So we would debit cost of goods sold for 142. We would credit merchandise inventory for 142. On August 26th, when we made a purchase on account of inventory, we record it like we always do when we purchase inventory on account by debiting merchandise inventory and crediting accounts payable for the amount of the purchase, which our perpetual inventory record tells us is $456. On August 31st, we're going to make another sale. We sold 10 units in total. Our sales price is $70 per unit, which means when we recorded that transaction, we would debit accounts receivable for $700, credit sales revenue for $700. Second entry that we need to record when we make the sale records our expense, and it's always a debit to cost of goods sold and a credit to merchandise inventory. For how much, go to your perpetual inventory record and total up everything that you have in the total cost section for that particular date. We sold 2 $36 units for a total cost of $72 on August 31st. We also sold 8 $38 units for a total cost of $304. Well, 72 plus 304 is $376 in cost of goods sold that we're going to expense at the time we make the sale on the last day of August. And lastly, let's figure out what our gross profit was using the FIFO method. Well, we had 2 sales transactions. We had $280 of sales revenue recorded on August 15th and $700 recorded on August 31st. So we had total sales revenue of $980. For cost of goods sold, we had 2 transactions. We recorded a $142 debit to COGS on August 15th and a $376 debit to cost of goods sold on August 31st. If we add those 2 together, we get $518, which means our gross profit is going to be revenue minus COGS, or $462.